All right, so chapter 10, it really focuses on liabilities, um, how they're reported, and how they're analyzed. We're going to do two pieces of financial analysis that I'm going to introduce you to, very things you might have seen before. All right, so learning objective 1 talks about all the current liabilities, and you've basically known and seen many current liability accounts over the course of this class. So anything that the company owes within the that 1 year period of time, one operating cycle of 1 year. And again, how do they pay a current liability? They usually pay those from current assets, usually through cash is usually how it's paid, right? However, if they can't pay a current liability, oftentimes they'll create another liability to pay it. That's not the best idea, but sometimes that does happen. You've been aware of a few popular accounts for current liabilities like notes payable and accounts payable. You also know about unearned revenue, the accounts. And there's a whole bunch of other payables that kind of are thrown in there, like interest payable, salaries payable, taxes payable, etc. You just have to understand that most liability accounts, with the exception of unearned revenue, have the word payable next to them. So a quick review on a note payable. It's a loan, right? The word note in accounting, every time you see that, it's a loan. It's going to require an interest payment. It's going to have a due date. The interest payment is usually most notes are short term, which means they're current. There can be some long-term notes payable, which means the due date will be past a year from the time it was taken. But overall, most of the notes payable we're going to come across are going to be short term. And notes payable basically are always showed up as a for folks that in this case the bank agrees to lend money to this company called Williams. It's a $100,000 12% 4-month note. Since it's on January 1st, this actually should be January 1st as well. And so the company will simply debit cash and credit notes payable when they actually get the loan. Right? So this is how the notes payable are on the books. At the end of the year, in some cases, it might not necessarily be the actual due date of the loan. And so if the loan is not due that year and they need to close the books, they're going to take an interest expense for the year that the loan was created, and they're going to set up an interest payable to show they're going to pay it in the next fiscal year. This you kind of know from chapter 4 when we did all those closing entries. And when they actually pay the note, in this case, they will show that the note payable has been paid. Thus, the debit to notes payable means no more notes payable. The debit to interest payable means that interest was paid. And the credit to cash shows they coughed up a lot of cash to pay those debts down. Okay. One of the most interesting things that you might not think about is that businesses have to collect sales taxes on behalf of the government. Okay. Sales taxes are a state and local issue. There's no federal sales tax. Sales taxes are mostly state and local issues. So businesses that sell products that are taxable are collecting tax from the customer. Well, that's not their money, right? That's money that's owed to the state government. And so that creates something called a sales tax payable account. Okay. And it usually works this way. So here we have a company, Cooley Grocery. They had sales of $100,000 and they collected $600 of sales taxes. Okay. So they collected $10,600 of cash. However, $10,000 of that is their actual sale. That's actually their money. But the other $600 was a sales tax that they're going to have to remit to the state government. Okay. Which is why before you can set up and open a business, you're going to need a tax identification number if you sell anything that's taxable. And that's usually done through your department. The Department of Revenue in New York is the one that takes care of that. And you don't have to worry about that part. Unearned revenues, you've seen all of this before, right? The customer is paying you before receiving the goods or the services. That's why it's a liability. Many types of industries collect money up front, and thus they have a large amount of unearned revenue. They earn it when, in the case of an airline, right, the plane takes off, or the magazines are delivered, or the night of the hotel stay is upon us, and that's when they earn their unearned revenues. So here in the illustration, they have Superior University. I guess that used to be what Dutchess was called prior. Sells 10,000 seasons football tickets, $50 each, to its 5-game home schedule. So they collect $500,000, but all of it is unearned revenue, right? Because the season didn't start yet. After every game, they will go ahead and debit the unearned ticket revenue, because this is a liability account, and move that money to ticket revenue, which is a revenue account. And so this is what all businesses have to do when they collect cash up front from customers, and they owe them. Okay. So you don't earn it, right? It's not actually revenue until you earn it. That's why this is called unearned revenue, is because it's not earned yet. One thing to know too is that there's a lot of long-term debt on the books, but whatever is due this year is part of current liabilities. So they call that the current maturities of the long-term debt. So here's an example where you have this construction company, Wendy Construction. They have a 5-year interest-bearing $25,000 note. The note specifies that on every January 1st, they're going to be paying $5,000 of that note down. Okay. So of the $25,000, that is a lot. Clearly, it's a 5-year note, so it's a long-term debt. However, the payment that's due this year, $5,000, is technically a current liability. The other $20,000 is still a long-term liability. So that's another something that you need to remember here. Okay. So not much going on there. Current liabilities is just more of a review. More things that you really need to know that is new, and it's all really about payroll taxes here. Okay. So one of the biggest things that businesses do is employ people, and they pay people. And in such, there's lots to go with that, because there are certain laws that impact businesses. First of all, one of the laws when you hire someone is whether you hire someone on an hourly salary, which is a wage worker, or you hire them on a monthly or yearly rate. So if you got hired for a job and they say, okay, we're going to hire you for this job at $20 per hour, well, then you're a wage worker. Wage workers are subject to that 40-hour work week rule, whereas any hours you put in over 40 hours a week is overtime by federal law. And that means they have to pay you time and a half, okay, for any hours over 40. But that only applies if you are a wage worker, okay? A salaried worker, if you get hired, and many of you might decide to become an accounting major, and you get your first job, and they'll say, look, we'll hire you for $60,000 a year. Well, then you're a salaried worker. Your $60,000 paycheck is per year. It's going to be divided by the number of pay periods, and that's going to be your gross pay every year. I mean, every month, every week, or every 2 weeks. And that's how you're paid. It doesn't matter if you work 40 or 50 hours a week, because salaried workers are exempt from the law that Congress passed way back in the 30s. Okay, so that means managers, a lot of administrative and sales staff that are hired on a monthly or yearly basis in terms of their pay, um, they do not get overtime. There are a few exceptions to this, but this is generally the case. So first thing is companies have to calculate your gross earnings. So like I said, for a salaried worker, that's easy. So you take your, let's say you get paid every week, and let's say you get hired at $52,000 a year. That's an easy one because it's $1,000 a week. That $1,000 is your gross earnings. For a wage worker, it's the number of hours you've worked times your hourly rate will give you your gross earnings. Okay. From that, there are some mandatory payroll deductions. In other words, there are certain payroll taxes that are mandated that everyone needs to pay. And the biggest one is FICA tax, Social Security and Medicare tax. It's called FICA. And that is simply required regardless what you earn, and in terms of if you're working only 1 hour a week or 51 hours a week, it doesn't matter. It's a required payroll deduction. If you normally are paying income taxes to the federal government and to the state government, that's also required. Those withholdings are also required deductions. So there are deductions that are mandated by law that are basically subject to around this idea of a payroll tax. Okay. And then of course, there's lots of other payroll deductions. The difference between net earnings and all those deductions is what you actually bring home in your check. That's your net pay. Okay. Simple enough. So the biggest issue that you got to understand is that the FICA taxes, all the taxes that they take out of your pay, by the way, is a liability for the company because it's not their money. They might withhold it from your check, but it's not their money. They're withholding it for another purpose. So for FICA taxes and for federal income taxes that are withheld from employees' checks, those are going to be due to the IRS. The IRS is the collection agency to the federal government. These two are federal taxes, government from Washington. And then the state income tax is required withholding if you live in the state of New York and you pay income taxes. And so all of those are going to be withheld from your paycheck, but the company has to set up liability accounts, payables, to show that they are going to be paid out because it's not the company's money. One thing to understand too is that corporations might have a very large payroll expense in total, but after all the payroll taxes that they are withholding, they don't need a lot of cash to actually pay the actual net pay for the employees. So the cash amount immediately that's due on payroll is whatever's payable. Okay. So after end of every week, companies will have a salaries, wages, expense. They'll, of course, know what taxes are withheld from the employees' checks and set up those payables. And then the difference is in your net pay is their salaries and wages payable. And when payroll is actually paid, in this case, it's the same day, that's fine. They will take away that payable and show that they paid you the cash. And again, this is in the aggregate. This is for all their employees, it seems. It's a pretty large number. But what you don't see is that employers also need to match the FICA taxes that you put in. So whatever they take out of your check for Social Security and Medicare, that's coming out of your check. What you don't see is that your business, your employer has to match what you pay on your behalf. So those taxes are part of a payroll tax expense for their FICA tax contribution or matching contribution. Another thing that they must pay is they must pay federal and state unemployment tax. This is only on a small portion of every employee's pay, but this is where the government gets money to pay unemployment benefits to people who get laid off. Um, this is the money that the government gets. Employers pay that tax to the state. It's an insurance program, basically. Unemployment isn't really an insurance program. And so, so employers pay those. You don't pay these. Your employer does. So that becomes their payroll tax expense, and it's going to be a payable until they actually pay it. Okay. So in this case, cargo companies' payroll was quite big, but their particular expense would be they had to match the FICA taxes payable. Plus, they had both federal and state unemployment taxes that they have to put aside to pay later. That is a payroll tax expense for them, and all businesses do this. And this is very important that they have to do. And you've seen a lot of fraud here. So your do-it exercises sort of go over basically those types of issues with salaries and wages and salaries and payroll taxes. It's very important that you know what's going on and understand that the business has a special role to play in all of that. Okay, so let's go to the next portion here. Just a description on bonds. Okay, so a bond is a long-term loan from an investor. Okay, bonds are, there's the stock market, which a lot of people talk about all the time, but equally important is the bond market, because it's certainly where corporations go to borrow money from investors. And that's all a bond is. It's a loan, long-term loan from an investor. Okay. The bonds are drawn up by investment banks and sold off in pieces. One bond is $1,000. These are interest-bearing notes payable. So again, it's a loan, so it's technically a bond is a note technically, and they promise a particular yearly interest on that money. Okay. We're going to focus on corporations, but the bond market is huge. Government agencies borrow money, and the federal government is a really large player in the bond market, but so are all the state and local governments as well. Dutchess County has bonds. They went through the same process in the bond market. Okay, so so that's what's happening there. So basically, again, just understand when a bond is issued, that's a corporation is selling a bond to an investor, and that means it's borrowing money. Okay, the person who is buying the bonds, who is lending the money to the corporation, is doing an investment in bonds, but that's not for the corporation. That's a loan. So just got to look at it. Bonds come in a couple of flavors, in essence. A lot of bonds actually are secured by assets. So this is true. Equipment bonds are quite normally secured bonds. So something that's secured means that there's an asset behind it. So in other words, the corporation pledges the asset to the bondholders in case they can't pay them back. So you lend me this $1,000 and my car or this piece of equipment is the collateral. So if I don't pay you back, you can take the car, you can take the equipment. So that makes bondholders feel better because they are getting that collateral. They feel like it's a more secured type of a loan, and thus it's a secured bond. A lot of bonds are what we call unsecured bonds. They're simply based on the credit rating of the corporation. Okay. Just like you and I as people have credit scores, corporations have credit ratings. And credit ratings could make it a very safe investment because the company might have a very high credit rating, or it might make it a very risky investment because the credit rating is low. Either way, investors want to know what risk is involved in lending corporations money so they can price it properly. The price of any lending activity is the interest rate. So if there's not much risk, you can't really demand a high interest rate because this is too much competition. Right? But when a company is more of a risk, it's a riskier loan. Well, then you have some leverage. You're going to say, okay, I'm interested in giving you a loan as an investor, but I'm going to need a high interest rate to compensate for the risk that I'm taking and lending you this money. And so it's usually the credit ratings of the corporations that determine the interest rates that they get to borrow from investors when it comes to unsecured bonds. Two other features of bonds that the book discusses here. One is there's a conversion feature for some bonds, a convertible bond, though the top does not go down as it shows here. A convertible bond basically is, remember what a bond is a loan from an investor. So if you decide to let a corporation borrow money, again, one bond is $1,000 loan. Well, what some bonds have is a feature. They say, look, you can continue to earn interest on this bond, and we'll pay you back $1,000 when it's due. Or at this time, at any point in time, you can convert your bond into shares of common stock. In which case, you're no longer a bondholder, you're a stockholder, and so it's no longer a loan because you've decided to become an owner. So a convertible bond simply gives the bondholder, the investor, the option to convert the loan into shares of common stock. In other words, they can go from a lender to an owner. Okay, and that's basically a feature of convertible bonds. A callable bond is something that can be paid early. So a call feature on a bond is simply saying, look, we know when we wanted this bond, it was going to be a 10-year loan. And when you gave us that money, but lend us that money, we were going to pay you interest for 10 years. But we're in a callable bond, we have the option of paying you back earlier. And that's not really great for the bondholder. It's a better option for the corporation to pay back early. It's not very good for the bondholder because the bondholder had already calculated in their mind, I'm making this loan for a 10-year period of time, and this is the amount of interest I'm going to be getting every single year through that 10 years. If you get paid back early, you don't have that interest coming in anymore. Now you got to find a new place for your money. And so it's not really in the bondholder's best interest that the bond has a call feature, but it is in the company's best interest that the bond has a call feature because it gives them the option of paying it back early. Okay. So basically, what this shows the next slide is what an actual bond looks like and some terms. So this is what a bond certificate looks like. All bonds are registered, and so all securities basically are registered, which means smack dab on the bond, there's going to be the lender's name. So if you're the investor, your name will be on there. Your address and identification are going to be on there because you are the lender. The company that actually borrowed the money is the issuer, so they're going to be listed on the bonds here. Okay. The amount of the loan is going to be on the bond as well. So this is a $5,000 bond is the equivalent of 5 bonds because each bond is a $1,000 loan. So if it's a $5,000 bond, it's technically like 5 loans, 5 bonds. Okay. So that's going to show the total amount of the loan. Okay. The company is going to pay it back on a certain date that's listed here, and that's the due date. The maturity date is the due date. That's when this $5,000 loan is going to be paid back to this particular investor. Okay. And companies are not just borrowing small amounts like 5,000. They're borrowing more like, well into the millions of dollars when they go for bonds. Okay. Multi-millions of dollars, sometimes hundreds of millions of dollars in bonds. There's a guaranteed interest rate on this bond. So it's a contractual rate. Word contract is there. And so basically speaking, every $1,000 of this $5,000 bond is going to be getting a promised 5.75% interest. So every single 1,000 is $57.50 of interest every year, times 5, because they have 5 bonds. So they're going to be getting, this interest is paid twice a year on bonds, every 6 months. So if this particular bond was issued in May, so 6 months after that, what is that, October, and then again on May. And so every 6 months, you'll be getting a check for half of what they owe you. At the end of that period of time, whether it's a 10-year bond or a 20-year bond, you'll get the money back. But every single year that bond is there, you're getting interest on that bond in 2 payments. Okay. We're not going to go over market price. Bond terminology is important, so that's why I went over that. But what we're going to do now is simply look at the balance sheet. I apologize for this makes you dizzy by going really fast, but it's the only way I can get through the slideshow. How they are reported on the balance sheet and how they're analyzed is the last thing that you're going to need to know about this chapter. Okay, so here's a company with a partial balance sheet showing that, again, liabilities are classified as either current or long-term, as you learned this way back in chapter 2, right? Classified balance sheet. And then there's usually a pecking order. Notes payable are almost, in every company I've ever seen, listed first as a current liability before accounts payable. And then all the other payables are listed accordingly. Remember, current liabilities are totaled. Okay. And then when it comes to long-term liabilities, here you'll have, if it says bonds payable, this is basically, this is a loan from investors. And in this case, it's a pretty large loan, depending on how, usually this company is probably not that big. So that $1 million loan from investors is pretty good. But again, this company also has notes payable listed under long-term, which means that whatever date of the balance sheet this is, this particular part of the note is due after 1 year from that date, which makes it long-term. Okay. So again, just to remember how they're reported, current and long-term, you'll see bonds under long-term. So 2 things to look at when it comes to analysis. And I think you've seen them before, way back in chapter 2, if I'm not mistaken. The first thing you might have known about is the current ratio. I think we did this back in chapter 2, where it's simply the current assets compared to the current liabilities of a company, okay, for any given year. So here is the information for GM in 2014. Looks like they had about $83.67 billion of current assets. Remember, current ratio is current assets and current liabilities. Current liabilities of $65.701 billion. So a current ratio of 1.27 to 1, $1.27 of current assets for every dollar of current liabilities, right? A little bit lower than it was in the previous year, but a lot better than the industry, which is basically breaking even. They have a dollar of current assets for every dollar in current liabilities. So in that sense, GM is in a better position than the industry, but I wouldn't be writing or bragging about this if I were them. Okay, so this is a liquidity ratio we've seen back in chapter 2 that repeats itself here. The other thing that's going to repeat itself, and I don't know why they put it into such small box here, is the debt to asset ratio. It's a solvency ratio that we looked at way back in chapter 2. And this is basically the total liabilities over the total assets. So perhaps you can see this better in the book, or you might need to, don't think you have to go see the eye doctor. It is really difficult to read here. So the total liabilities and total assets are listed here. This ratio you're going to need to know. There's another ratio that's introduced called the times interest earned ratio, which looks at, basically what it looks at is its net income over its interest expense. How many times does the profit pay the interest? Okay, and that's basically how they look at it. So here the debt to asset ratio for GM in 2014 is 80%, which is very high. Am I seeing that number right? Yeah, 80%. That's very high. That means that 80% of its assets are paid by debt or required by using debt. So that's relatively high, certainly compared to the industry. It's much higher than the industry average. Okay. But in terms of their ability to pay the interest on their debt, so this might seem like they have a lot of debt, but is it costing them a lot? Well, how much is their profit able to cover that interest expense? Well, if you take the net income plus the interest expense plus the income tax expense and divide it over the interest expense, you'll see that they have more than 11 times the amount of profit to pay their debt. Which is a very high rate compared to the industry, which only has about 3 times, the profit only represents 3 times the amount of debt payments, interest payments on their debt. So in that sense, GM's doing much better because their profits are much, much higher than the amount that they actually pay interest on their debts. And that is that. I said it was going to be brief. But I wasn't kidding. All right. Questions on that?